Hey everyone, today I'm going to be talking about the 10 key investment principles for success. Whether you're a beginner or a long-time investor, whether you've got 100,000 or 100 million, these principles apply to you. These are the key things that you've got to keep in mind as an investor to have long-term success. Some of these might be just reminders for you. You've heard them before, and some of them might be new, but let's just get started here. So, number one, all successful investing is goal-focused and planning-driven. Okay, a lot of times people come in and they just want to say, hey, here's my portfolio. What can you do with it? What's the highest rate of return you can get? And we've got to go back first and discover what their goals are. Your priorities are what drives the portfolio. So you start with goals, then you figure out the game plan, and then you build the portfolio. Too many people want to start with the portfolio. They want to talk about specific stocks or things they're excited about, stuff they've heard in the news, the financial entertainment news that they're really excited about. But really, you've got to go back to goals first. Okay, all failed investing is market focused and current outlook driven. That's the financial entertainment news. That's the fake fortune tellers. That's what's happening today. What do I need to do? What do I need to buy or sell? Getting caught up in the hype. That's driven by fear or greed or other, feelings or emotions. So really, you've got to first look at, what are my goals? What are my goals for this money? And then create a game plan and then build the portfolio. The portfolio is the servant of your goals and your plan. Number two, human nature leads to failure. So all of us, advisors included, have the emotions that go with money decisions. So as you can see here, human nature doesn't distinguish between temporary declines and permanent losses. So volatility does not equal risk. When you're investing in the financial markets, it's going to be volatile. You can't let the feelings and emotions and the human nature side of you get the best of you. So if you think about someone who's so excited to buy a house and everyone around them knows they're overpaying for the house, but they're so excited about it because they've got that emotional attachment already, they're probably going to overpay. So when you're making financial decisions, you want to go kind of against the grain. So if you look at this little chart here, when things are high, people feel greedy and they want to buy more. A good example of that, Tesla stock is over $2,000, and suddenly people who've never even talked about investing are talking about buying into Tesla stock and getting rich quick. So when things are high, that's when our temptation is to be greedy and to buy more. When investment prices are low, that's when we get afraid and we want to sell. When really we should be doing the opposite. We want to be buying low and selling high, and not vice versa. So it does take faith and patience and discipline, and you've got to stay long-term objective. And that goes back to number one. You've got to be looking at your goals and your plan before you make any decisions in the moment. Number three, expect bear markets and recessions. Okay, be a long-term goal-focused investor. Bear markets and recessions are normal. They're supposed to happen. Recessions and market declines come and go. It's nothing to be shocked about. Look at this stat right here. On average, the S&P 500 declines 15% during each year and 30% once every 5 years. So these declines are normal and they're temporary. So at any one point during the year, there's going to be a big decline where everyone's patience is being tested. Their commitment to their strategy is being tested. Very important to just know that those are coming. Those recessions and bear markets are coming. Number four, resist chasing. Okay, avoid the temptation to follow the crowd. Don't chase past returns of investments or exciting fads that are getting all the hype. A couple of years ago, I remember around Christmas time, Bitcoin was all the talk. Everyone, the people bagging groceries are talking about getting rich off Bitcoin. Bitcoin's going to $100,000 a coin. It's when you get into speculations, that's not the same thing as being a long-term investor. So make investment strategy decisions that fit your financial goals and your planning. Don't chase returns and don't go in and out. Be a long-term committed investor. Here's a great chart. Growth of 100,000 over 40 years grows to 2.3 million if you were invested every day during those 40 years. If you try to time the market and you said, I want to get out and get back in and get out and get back in, and you just missed the best 25 days out of 40 years, if you just missed the best 25 days, look at the difference. Not even $500,000. So you're missing a massive, massive portion of the return by trying to time it and guess and chase back and forth. Number 5, think long-term. Know the difference between a temporary decline and a permanent loss. The longer you stay invested, the greater chance you have of success. Look at these rolling returns of stocks. This is the S&P 500. If you're invested for at least a year, you've got a 75% chance of being positive, having positive returns. No matter when you start that 1-year clock in that significant time period of 1928 to 2018, you're going to be positive 75% of the time. Rolling 5-year returns, it's almost 90% of the time. Rolling 10-year returns, almost 95% of the time. And 20-year returns, 100% of the time you were positive. So really, most clients that we're talking to, you're probably not investing in stocks if you only have a year to invest. Okay, if you're going to need that money back in a year, you're probably not going into stocks. But if you can be a long-term investor, I like the odds. Okay, you have got a great chance of having positive returns. So you've got to stay committed. Number 6, volatility is your friend. Okay, volatility is good. Investing in the markets is like being on a boat in the ocean. There's supposed to be waves. It's not supposed to be a flat lake that's just calm all the time. So don't expect the markets to move like a CD at the bank. They're not the same thing. And that's why you don't make as much in the CD investments. You make a lot more in the markets over the long term because you've got volatility. So volatility can be beneficial if you're prepared for opportunities. It's a great time to be an investor when the markets are going up and down a lot. Number 7, avoid market timing. Okay, this is very, very important. Time in the market is more important than timing the market. There's a big difference. People get caught up in saying, is this a good time? Or should I wait till next week? Or should I wait till tomorrow? Or should I wait till next month? But really, if you look back at the charts, like the previous page showed you, if you're investing for at least 5 or 10 years, you're going to have a positive return over time. So your portfolio is based on your long-term goals, not the whims of the market. So don't try to time it. Create a goal-based plan and then build your portfolio around that and avoid market timing. Number 8 is look beyond the headlines. Okay, the financial news media is not here to support your personal goals. Typically, they just throw out a bunch of exciting headlines each day, and it could be completely different the next day. And yet, a lot of people, unfortunately, are acting on those headlines and making big financial decisions, even though there's no context that fits within their goals or their plan. So if you look at, these are 2 interesting examples. Here's Time Magazine cover in March of 2009, talking about the death of equities, holding on for dear life. It's time to sell your stocks. And the next 10 years produced a 336% growth. On the flip side, in 1999, this is before the tech bubble, San Francisco Magazine, have you made your million yet? Buy, baby, buy. Talking about just get rich quick on tech stocks. And in the next year or so, a minus 104% return. So do not follow the news headlines as your source of financial advice. The forecasts are not going to be accurate. If they could guess, none of us, even financial advisors, none of us can guess and predict accurately. So don't pay attention to the headlines or get caught up in the hype. Number 9, be diversified. Not all of your investments will be growing or declining at the same time. It's okay if some of your investments are not doing well while others are doing great. That's okay. That means your portfolio is actually diversified. It protects you from the inability to predict the future. So having concentrated investments, that will build wealth. A lot of people do that in their own business. You're concentrated in one investment, your small business. Or maybe you owned one company stock, and it went up a lot. That's great to build wealth, but not great to preserve or keep wealth, because what goes up will eventually come down. So diversification is definitely important. We look at that for every client as part of their success strategy. Number 10, finally, focus on what you can control. How much you spend, how much you save, when you withdraw from your investments. These are things you can control. You cannot control interest rates. You can't control what the economy is doing, monetary policy. You can't control whether the markets are going up or down. But you've got to remain faithful to your overall financial plan and look at what you can control. What habits and what financial decisions are within your power. So we always want you to look at things that matter, things that you can control, and focus on what goes in the middle right here. So hopefully that was a helpful review. Maybe you picked up one or two insights or reminders. It's very important to keep these principles in mind when becoming a successful investor. Like I said, whether you've got 100,000 or 100 million, these principles apply the same. Hope you found this valuable. And if you'd like to have a conversation with our team, go to goalsconversation.com, and we'd be happy to have a chat about your goals and put together a plan for you that will help you be a successful investor. Thanks. Have a great day.